So as you know, bonds are an example of a lending investment, right? Stocks were an example of an ownership investment, lending investment. So now the relationship you're going to have with the corporate, with the company, instead of being an owner, part owner of the company, now you're going to be a lender. You're lending to the company. Okay, so a lot of the inverse of what we saw in chapters 7 and 8, we talked about loans and mortgages, right? Then we were the borrower, right? Now in bonds we become the lender. That's right. So, and of course you can make loans to businesses, you can make loans to governments. Okay, so and we'll talk about them in turn. We're going to start with some sort of general terminology explanation before we get into the differential between the corporations and the government bonds. So we take a look at basic bond terminology, okay? Understanding basically the types of things that that you need to know when it comes to bonds. First of all, there's something called par value, okay? And par value is basically printed on the bond. It's the amount that you will get back when the bond matures. Okay, so again, we're talking what is the maturity, right? The maturity date is when the bond is, when the loan is over. When the loan is over, and you're going to get your money back. Okay, so let's say the par value is $1,000 on the bond. Okay, so basically the bond says, we'll take Apple. Okay, Apple Incorporated promises to pay to the bondholder $1,000 10 years from now. Okay, so there'll be a date, a maturity date. The maturity date will be, I'm sitting here right now on June 1st, 2019. So let's say they issued on June 1st, 2019. I promise to pay to the bondholder $1,000 on June 1st, 2029. Okay, so bonds are by the way, very long-term in nature. Okay, they're usually decades long. Okay, so you have to take that into account too. So you know, you'll be a lender for a long period of time. Okay, so that's the par value. That's what the par value means. Okay, so it's printed on the bond as the repayment amount. Okay, and the repayment amount will happen many years into the future. Okay, coupon interest rate. Okay, basically while you're waiting, right, for decades, right. What do you get for it? Right? Are you getting paid to wait? And the answer is, oh yeah, you're getting paid to wait. Okay, and you'll be getting paid interest. Okay, just like when you have taken a loan, you pay interest. When you hold a bond, you're going to get paid interest. You're going to have interest income. You see, and so the coupon interest rate, again, printed on the bond. Okay, says until the maturity date, I'm going to pay you X% of income. X% interest twice a year. Okay, so there are semi-annual payments. Okay, and so the payment dates will also be printed on the bond. Okay, generally they're 6 months apart. January, July, February, August, March, September, April, October, May, November, December, June, December. You know, 6 months apart. And so generally, so if they're telling you that it's an 8% bond, okay, that's 8% per year, not 8% per payment. Okay, so you'll get 2 payments of 4% for an 8% bond. Okay, and that will be a percentage, of course, of the par value. Right. So that's basically how bonds work. The bond indenture basically is just a outlines the provisions of what's in the bond. And we talked about a stock prospectus a couple of classes ago. We talked about the fact that if you can issue stocks to the public, then you have to give them information beforehand, mommy and poppy information beforehand, so that you don't mislead them, you don't defraud them. Same thing when it comes to a bond, because bonds are also going to the public. They're being publicly issued, just like stocks. As a matter of fact, as we'll find out in a few minutes, they're also publicly traded, just like stocks. So, the bond indenture describes the provisions of the bond itself to the public, and that has to happen before the bond can be issued. It's got to be approved by the Securities and Exchange Commission, just like a stock prospectus has to be approved. So those are the types of things that you have to be aware of. Call provision. Remember we talked about call risk way back when? Chapter 11. Yeah, I know you do. So the call provision simply means, of course, the issuing company's right, to retire the bond early. We talked about this with mortgages, right? We said, make sure that there's no prepayment penalty when you take out a mortgage. And this way, especially if it's fixed rate, right? If the rates go down, we could refinance by prepaying the mortgage, right? Well, you know what? Company wants to do that with a bond too. They want to say, hey, once a bond interest rates go down in the market, I want to have the right to retire the bond early, right? So I can reissue new bonds at lower interest rates. Or let's say the company makes gads of money and doesn't want to have debt, right? They want to have the right to retire the bond early. That's what a call provision is, okay? Generally, they'll give you a little bit of a sweet deal. The call will be at a price over and above the issue price by about 5%, so it's not the worst deal in the world for a bondholder, okay? So that's what a call provision is all about, okay? Those types of things. What else we want to talk about? Sometimes there's a sinking fund. The sinking fund basically provides for the corporation to be obligated to set monies aside for the repayment of the bond principal down the road, so that you know that you're going to have that done. And talking about security, okay, as we were, you notice that corporate bonds, again, bonds that are issued by companies, private companies, Apple, Google, Microsoft, etc. Their bonds can be secured or unsecured, just like debts. Going back to Chapter 7, could be secured or unsecured, right? We saw a secured debt being a mortgage, an unsecured debt being a credit card debt. Here, too, sometimes corporations will issue bonds that are secured by their assets. Okay, so their assets are basically pledged to secure the bond. In other words, if they can't pay the debt, then the bondholders have the ability to take specific assets of the corporation, okay, which makes it less risky, which means the interest rate will be lower than on an unsecured bond. Unsecured bonds are called debentures. And unsecured bonds basically are saying, loan us the money, trust us that we'll pay you back in 10, 20, 30 years, and you bear the risk, obviously, that they'll be financially able to make the repayment. Obviously, since they're riskier bonds, the interest rates will be higher on a debenture than on a secured bond. Higher interest, why? Higher risk, higher reward. But you already knew that. Okay, so when it comes to corporate bonds, this is what we're talking about there. Certainly very important. I want to flip over to figure 13.4. It's an example of a corporate bond that is listed on the bond market. Yes, bonds do have a market, just like stocks have a market, right? So, I mean, basically, you may have a bond, and the bond here the issuer's name is Walmart. So, anybody familiar with Walmart? Walmart stores? Anybody? Anybody? Yeah. Walmart's a very big, obviously, retail chain. Everybody knows about it. And so they have issued a bond here. Basically, as you can see, the coupon rate, 5.625%. Okay, that's the rate printed on the bond. We'll pay you 5.6% per year as a percentage of the par value. Okay, which is generally $1,000, the par value. So we'll pay you 5.625% of the bond. Okay, chopped up in two increments semi-annually. And the maturity date will be April 2041. 2041, right? That's over 20 years away from where we are here in 2019, right? So, am I going to be willing to sit and wait for 2 decades to get my $1,000 back? Was I need it for something else before then, right? And this is why these bonds are publicly traded on the market. So you don't have to wait to 2041. You can sell them when? Yes, today. Very good. Right. You can sell them whenever you want. The bond market is actually bigger than the stock market. Okay, so there's something for you to chew on a little bit. Okay, good. Then they talk about rating. Moody's S&P. What the heck? Right, I know. If you take a look back on table 13.1, few pages prior, you're going to see in Table 13.1 that they have bond ratings. Standard & Poor's and Moody's, okay? These are companies whose job it is to rate the safety of a bond, okay? They measure it by, again, how much debt does this company have, how much cash does this company have, how much does it earn, right? And if the company obviously is the bond secured, right, or unsecured. So these types of things go into it, and then they rate the safety of the bond. Okay, AAA is the highest, right? The most safe bond, AAA, and they go all the way, as you see. Once you get into the B's, you have what we call junk bond status. It's very speculative. In other words, the chances that they may not be able to pay you at maturity are pretty significant. Therefore, be careful out there. Okay. So, fortunately, the rating on the Walmart bonds are AA, right? Just it's niche below maximum security. Okay. So they are pretty secure bonds. Walmart basically is a very secure company. We'll see basically whether or not Amazon has anything to say about that, but Walmart is just a huge company. I don't think it's going anywhere anytime soon. So you could feel pretty safe that your $1,000 will come back in 2041. Okay, and then it says something. It says price. What price? 105.52. What's that all about? Okay, well, let's talk about it. Okay, as I said, it's traded on the market, right? Okay, so a $1,000 bond isn't necessarily going to be traded at $1,000. The prices go up and down, like they do on any market, okay? What would make a price go up over, by the way, this is 105 is a percentage, okay? So the price of this bond, you want to buy a $1,000 Walmart bond, you know what you got to do? You know what you got to do? You got to pony up $1,055.20, 105.52% of $1,000, okay? So to buy a $1,000 bond, you're going to pay over $1,050, okay? Why? Why would you do that? That's crazy, right? They're going to give me $1,000 back, and I'm going to give you $1,055 to get $1,000 back? Well, quite simply, let's go back to that interest rate, right? 5.625%. That's a pretty lofty rate, right? Compared to what interest rates are going in the market these days, right? In market interest rates 2-3%, right? So you're getting a fat interest rate, right? An interest rate that's higher than most other people are going to get. Well, that's why these bonds are trading at a, wait for it, premium. Okay, premium. They're trading for more than its par value. And you're willing to pay more than the par value because you love that interest rate so much, right, that you're willing to pay a premium to get it. Okay? So bonds very much move, the market price moves it inverse to interest rates, right? So as interest rates go up in the market, bond prices tend to go down. When interest rates go down in the market, bond prices tend to go up. Inverse relationship. See that? Okay, very good. Okay, so as I said, bond prices change. They change every day. They change every minute during the trading day, and that's the change in the bond price you see there. And then we have something called yield to maturity and current yield. I want to concentrate on the current yield. Okay, current yield means, okay, what it means is basically this, right? If I'm going to get $56.25, okay, a year, because why? Because that's 5.625% of $1,000. Right? $1,000 is what? Is the par value. I'm going to get 5.625% of the par value, right? But I'm paying $1,055, right, to get 5.625% of $1,000, or $56.25. What is my yield? Right? If I'm getting $56.25 on $1,055, my yield, that's the current yield. That's your yield buying it at a premium. And you notice that that yield, of course, is somewhat below the coupon rate. Why? Because you paid a premium. Okay. And you see the bond is not callable. Okay. So Davidoff, can the inverse be true? Can you actually buy a bond for less than $1,000? Of course you can. Okay? That's called buying the bond at a discount. Okay? Why would a bond be available at a discount? Well, first of all, maybe its coupon rate is too low, lower than the market, right? So who wants that bond? No one wants that bond at that lousy interest rate of 1%, right? Well, wait a second now. If I'll have to pay $900 for the right to get back $1,000 in the future, then that effective yield will be higher than the 1%, right? So that's one reason. Another reason might be that rating, right? The company may be in trouble. An AA rating may go down to, again, B, C, right? And become very speculative. We don't know if the company's going to make it to 2041 because the company's in trouble. Okay, so should I buy their debt? Should I basically loan money to a company that's in trouble? Well, you know what? If the interest rate is high enough, I might want to take that chance. Remember one thing: bondholders get paid, right, before stockholders get paid. Right? So if a company goes out of business, they got to pay off their debts before they can pay off their stock, their owners and their stocks. So I might be inclined to take a chance at some stocks that are a little bit, some bonds that are a little bit more risky because the interest rates are so much sweeter. And if they do pay off the debt, remember, they're legally obligated to pay that debt, right? As long as they're not in bankruptcy, they're going to pay it. You're getting a nice interest rate if you buy it at a discount. So yes, the answer is yes. That bonds could be trading at higher than $1,000. They could be trading for lower than $1,000. The answer is yes. Glad you asked that. Okay. So this is what corporate bonds are all about. Again, as I said, governments also issue bonds. We're going to talk about treasuries in the next class. Treasury bonds, U.S. bonds, widely thought of as the safest investment in the world today, U.S. treasuries. Okay. 2008, when every market was going down, U.S. treasuries was the only market that was going up. Okay, so we'll talk about that. Municipal bonds, again, we talked about this back in the tax section because of that great tax advantage to municipal bond. Municipal bonds are basically bonds issued by governments in America other than the United States, state governments, city governments, municipalities, things of that nature. And as you know, when government bonds are issued by states or cities, they are tax exempt. The interest, that is the interest that is paid by a state or a city, right, is tax free, not tax deferred, tax free, right, to the holder. And that's why wealthy people love, they don't like, they love municipal bonds, right? Because the higher your tax rate, the more valuable the interest rate on a municipal bond becomes, as you're going to see in the homework assignment for the chapter. Okay, so municipal bonds are amazing. They go for tax-free. If you buy a bond in the state where you live or the city where you live, then the bond is not only tax-free on your federal tax return, it's tax-free on your state tax return and your city tax return. So New York State bonds are always advertised as being triple tax-free. Free of federal taxes, free of state taxes, free of city taxes. Triple tax-free. Now if you buy a bond in the state of California, you won't pay federal taxes on it, but you will pay New York State and city taxes on a California bond if you're a New York State resident. And that basically covers the bonds for this lecture. We're going to start the next lecture by talking about U.S. Treasury bonds, and then we're going to go morph into other alternative investments such as real estate, commodities, and things of that nature. So stay tuned, and we'll get right back at you with the rest of the bond chapter and alternative investments.